For more on the markets, let's bring in Alec Young, global equity strategist at S&P Capital IQ, and he joins us now from his office here in New York. Alec, welcome back to Bottom Line. Always a pleasure to have you on.
Great to be here, Mark.
Alec, that positive reaction that we're seeing in the markets today to that concerted effort, as Matt just pointed out, by the 6 major central banks, is that a temporary fix? And is today's market reaction a temporary reaction?
Well, I think the big thing that this coordinated global central bank action does today is it really takes the threat of a global credit crunch in the near term off the table. By infusing capital into these troubled banks, you really greatly reduce the odds of another Lehman type of event, of global credit markets seizing up, through the end of the year, which I think is really something that markets were very worried about up until today. So from that standpoint, this is definitely bullish for global equities in the short term. The problem with it is that the central banks are just addressing a symptom of the crisis, which is troubled banks that own too much sovereign debt. You're not addressing the root cause, which is a lack of market confidence in the ability of Spain and Italy to pay their debts. And so I don't think it's a long-term fix. I don't think it ends the crisis, but certainly it does reduce the risk of a global credit crunch, and that's certainly great news for stocks in the short run.
But does it also force governments then to take another look at their books and perhaps institute long-term structural reforms?
It needs to, because in order to kind of permanently diffuse the crisis, I think that the ECB has to take a much more active role in buying peripheral bonds in the secondary markets. And one of the reasons they've been reluctant to do that, they're worried about creating moral hazard, about letting some of these profligate countries off the hook. And so we really need to see some serious austerity in these countries. And one of the things that's been bandied about lately by the European countries is the idea of a fiscal pact that really ties some consequences in for countries. If they don't cut their spending, they lose that ECB support. So that's going to be part of the longer-term solution, definitely.
Yeah, Alec, today's market rally also trimmed that 6th monthly decline in 7 for the S&P 500. It leaves the index down just over 1% for the month. For the year, the broader market's down about 1.75%. A month from now, at the end of the year, what's that number going to look like?
I think it can probably be higher. I think while this news today does not address the root cause of the concern, which is a lack of confidence in sovereign debt, it certainly does remove the threat of a global credit crunch. And I think it'll allow especially U.S. investors to focus on a lot better news here at home. And I think we can see the S&P 500 grind a little higher by the end of the year.
Now, ADP reported today that U.S. companies added more workers than anticipated this month. 206,000 was the number. That increase was the biggest this year. Is it enough to ease fears that the job market's stagnating, or is Friday's jobs report from the Labor Department going to tell the real story?
I think the payrolls always tell the real story. The ADP is very encouraging, but I think we need to see that confirmed by the payrolls.
Yesterday, S&P lowered its credit ratings for many of the world's largest financial institutions, including the biggest banks here in the U.S. S&P said that move reflects its new criteria for banks. We should point out, we know that you're not on the firm's credit rating side, but can you give us a sense of what those new criteria might be?
No, because I'm not on the credit rating side, I find out those things when the rest of the world does. What I can tell you is today's news, where global central banks are looking to shore up the liquidity of the banks globally, is definitely a positive offset on the heels of the news that you just mentioned.
Alec Young, global equity strategist, S&P Capital IQ, joining us from here in New York. Alec, it's always a pleasure. Thanks so much.
Thank you.